Good morning. I'm Shweta Jain, CEO and co-founder of Senora Advisors. Welcome to Saturday Talks. I'll just give you a brief of what we do. So we at Senora, we are registered as an RIA under SEBI. We deal with primarily with direct equities for HNI and super HNI categories of clients. This is our third session of Saturday Talks. The idea and the objective of conducting these sessions is to discuss various topics that can impact the financial health of our investor community. Last we did was on blockchains and cryptocurrencies, which is the current latest digital asset. Now today's session is on balancing debt and equity in ever changing environment. Currently the macro environment that we are operating in is very volatile, be it the Russia Ukraine war, the concerns rising on China Taiwan conflict, or UK US hitting recessions, rising inflation and thus bond yields, Fed and RBI rising repo rates or Fed rates, money moving from Indian equities to developed markets. So there's lots happenings around the macro environment, considering Indian as well as global environment. Indian equities itself in the last few days have shot up, given decent returns in last, let's say, 15-20 odd days. Not much anticipated by the players themselves. So in such scenarios, what should we as investors do? Let's put everything into perspective and hear what the stalwarts that we have amongst us today speak in their respective fields. So we've already heard a bit from Mr. Mahendra Jaju. He is the CIO of fixed incomes at Mirae Asset Management. He has over 30 years of experience into the financial field, with more than 15 years of experience handling fixed income management assets. He's responsible for looking at overall fixed income funds for Mirae Asset Management Company. Today, he will take us through what's happening on the macro levels and how does debt investments fit into the entire picture. Then we have with us Mr. Bharat Pathak. He is the founder director of Wealth Managers Private Limited, which is one of the biggest distributors based out of Pune. He, starting his career as a CA, he moved on to become one of the biggest and the most respected financial advisors in our field, out of pure passion towards his equity markets. So he'll discuss what's the right asset allocation strategy and how does this changing environment should be considered overall for one's long-term goal orientation strategy. Then we have Mr. Mridul Jalan. He's my partner. He's the MD and co-founder of Senora Advisors. He's an MBA from IIM Calcutta, and he's worked with leading domestic institutional broking houses where he's gained proficient knowledge into equity markets. So be it technicals, fundamentals, or derivatives and various other aspects of financial markets. He will take us through how equity investments fit into the picture and how can it help for one's long-term wealth creation journey. Before we start the session, I would like to inform the attendees that we have a Q&A session at the end of the entire panel discussions. Meanwhile, they can post their questions in the Q&A tab that they can see on the screen. With that, I would like to open the floor for discussions. I would like to start with Mr. Jaju. So can you please share your insights on how debt investments should be envisioned in one's asset allocation perspective?
Thank you, Sweta. First of all, my regards to Bharat sir. Good to be on panel with you, sir. And my regards to Mridul. I know him to be a very shrewd investor. So I'm delighted to be on this panel. In so far as the debt investments are concerned, in terms of the portfolio and part of the investment strategy, I think Bharat sir is the expert as the wealth advisor. I am just a fund manager on the fixed income side. But let me just put things in perspective as to where the fixed income stand. Of course, there is a lot of glamour about the equity, and especially in the mutual fund industry, there is a lot of glamour attached to the equity side. But just consider the fact that for the last 3 odd years, almost 60% of the global outstanding debt was yielding negative return. But still, people who invest in debt were invested. For the last couple of years in India, we have always cribbed about the low interest rates. Savings accounts are giving 2.5%, but the banks still continue to see higher growth in deposit than in the credit, right? So we need to understand that debt is an integral part of our investment. The biggest headline that come out from the industry in terms of the potential for the financial services industry is that a significant chunk of the household financial saving is blocked into the bank deposits, which are actually yielding negative return on inflation adjusted basis. And I think 99% of our time as financial experts or you people as financial advisors spend on explaining to the client how shifting from the bank deposits will improve his portfolio return. So the attachment to the debt is of a nature which is very much integral to the psyche of the investor. And I think it is not the right thing to insult the investor's intelligence by saying that he doesn't know where to invest. Obviously, debt has a utility in his portfolio. We saw just after the outbreak of the COVID that Nifty took 30 years to reach 13,000, 14,000, and then it fell 50% in a matter of 1 month to 7,000, and now it is back to 17,000. Now, when you have this kind of volatility in high risk assets because there is no free lunch, you need an anchor in the portfolio. And then imagine a person investing for 50 years of his life or 60 years of his life, and then he's about to retire the day before the COVID lockdown happens, and his savings just go for a toss. So I think there is an anchor, there's a diversifier, and then there is a reserve to be used when those kind of opportunities come. So debt has multiple roles, and over and above, the most important part is that debt gives you a predictable return. So if you are investing for a specific purpose, and when you are nearer to your timeline in terms of your objective, at that time to buffer yourself from the volatility, debt plays a very important role. So, and then on the other side of the utilization of the debt, I mean, we know that debt is a very significant component of the equity return for the corporates in terms of the leverage. So there are multiple areas where the debt has a utility in the portfolio for the investor. I hope, Sweta, I answered the question you asked, because it was a little bit.
Yes, absolutely. So one point you mentioned was, it proves as an anchor, it gives you a diversification. So is it that investors should look at it only as a plan B in their overall returns? Because I'm pretty much sure everyone in the entire, it's a human nature that I want more returns from my investments.
No, I think that is again one of the misconceptions, that it is not plan A. It is very much part of a plan. It's not plan B. It's very much part of plan A. You cannot have 100% in equity or real estate or crypto, for that matter. That is the new rage. You need a diversified portfolio. I think the whole basis of the financial investments starts from the portfolio diversification, because you can't keep all your eggs in one basket. Diversification comes in multiple areas. So it has a geographical diversification. Even if you are investing in equity, you are trying to invest in, and if you are a large investor based in a developed country, in USA, you are investing in emerging markets, you are investing in frontier markets, you are investing in large cap, small cap, nano cap, and then you are investing in property you have read. So I think debt is very much plan A. It is not plan B. All I'm saying is that, let's say if we have a good example right now, that you are an investor with a debt to equity allocation of 40-60, which means you are 60% in equity and 40% in debt. And then suddenly after the COVID lockdown, market falls by 50%. So your debt allocation suddenly becomes higher than 40%, equity becomes lower. At that time, you need to rebalance your portfolio. So with that diversified portfolio approach and a periodic rebalancing or a triggered based rebalancing, you automatically invest in equity when the markets are very cheap and vice versa. So there are very subtle nuances in terms of the portfolio management. I'm not a portfolio advisor or portfolio expert. I can just talk about fixed income. Maybe Bharat sir can throw more light, but this is how the balancing works. So I think it is a completely misguided notion to think that debt or equity or real estate is part B of the portfolio. It is always part A of the portfolio.
also, sir, I assume when as investors, as layman investors, we assume debt is only majorly fixed deposits that we put into the bank or something like that. There are corporate bonds, ratings, the debt agencies that rate those corporate bonds. There are various other forms. There are debt mutual funds that invest in only debt schemes, pension funds. So how does, within the debt spectrum, how does an investor decide which category to invest in, or how does the mechanics work there?
I think there is a case for financial literacy, better awareness, because it's a question of the evolution of the markets. If you look at 10 years back, people were very afraid of investing in equities market also. Then people thought that they can invest directly in equity. Then now uh, there is almost a rage that mutual fund sahi hai or SIP. So even a pan wala, auto wala, I mean, I'm sure you have this experience that you get into a cab and then you start talking to the cab driver. The moment he knows that you are a portfolio advisor, he will say, कौन सा म्यूचुअल फंड में करना चाहिए or which stock to buy. So I think the question is about the evolution of the financial markets in India, and then about the investors becoming smarter about choosing their options. So fixed deposit is an option where you go to a roadside dhaba when you are traveling, and the limited choice you have is dal roti and paneer, or at the best butter chicken if you are a non-vegetarian. Then you come to Bombay and there are so many restaurants, you find it difficult to choose where to go. So I think the higher you move in terms of your investing intelligence quotient, the better options you get. I can tell you with a reasonable amount of confidence, having spent so much time in the mutual funds, that even the best of the financial advisors still don't have enough to understand which mutual fund, which debt mutual fund to choose. Forget about choosing between deposits. And so we have a long way to go. But the confidence I have is that 10 years back, people had very, very strong dislike for equity. And that has completely evolved into equity being the only or the first choice for the retail investor. Uh, just if I may add, when you are talking about investing in debt, at different cycles of life, the debt investing approach has to change. And I meet a lot of young people, 22, 23, who are just starting their career. They come to me, sir, I have started earning 10,000 rupees per month or 1 lakh rupees per month, whatever. Where should I invest my debt component? I said, you are a stupid guy. You should not be investing in debt. Go and buy a house which is 4 times your ability right now. Go and buy a car which is bigger than your earnings capability now, because 4 years time, 5 years time, 10 years time, when you grow into your job and you earn 5 times the salary, that time you will have arrested inflation, right? So it is not for you to invest in debt now. You should start investing in debt at the age of 40, 42, when you have achieved your basic needs in life, when you have started having investable surplus. Just because you're getting a cash flow, that is not your investable surplus. And even if you have investable surplus, like an entrepreneur, invest it in your house, your future requirements. Because when you are earning 10,000, you buy a house of 1 crore. When you start earning 1 lakh, that 1 crore EMI will look very small. And if you have not bought at that time a house which is 4 times your capability, you will regret. He says, no, no, sir, what happens if it goes wrong? What if I lose my job? Maybe I want to start on my own after 4 years. I said, if any of those things happen, you are not spending it in a revenue manner. At that time, you sell your house and repay your loan if that kind of a situation comes. But you cannot start your life on a negative note. You have to start your life on a positive note. A slightly long answer, but I think I wanted to cover some of the other side also, that debt is not always about investing, it's about borrowing also at the right age.
Absolutely. Mridul, what's your perspective on this age dynamics? Does equity fits into this 22-year-old bracket frame? How does equity comes into the picture here?
So Mahendra sir has actually ticked up on a very, very important point, that debt and equity has a right balance in terms of when put on the parameter along with risk. A 22-year-old or somebody who has just started his earning life will have a lot more risk taking ability, and he has a long way to go. And hence, putting money in a debt, which is a low risk product, is wrong for the client, for the investor, for the individual. Whereas equity is something where I believe that it's about the longest tenure. So when you're 20, 22 years old, you need investments with the longest tenure, and which means you need equity, because you need to save for 30, 50 years and not for 10, 12 years. The longer the tenure, trust me, the more allocation you should have in equities is what I believe. Because not only we have seen historically that equities give more return in the long term, the fact that if you have a very long tenure, which means you have time to pick the right stocks and make a right portfolio. And in terms of balance, I believe that what Demon did, what lot of other factors did is moved the money from household bank deposits to debt, and from there it has started moving to equities. Debt played a very important role, because from a household, you 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 uh, you are a earner and a house manager yourself, Shweta. Your own savings first will move from in your cupboard into a bank account, and from a bank account to a safe product, and then will move to equities. To expect that money to move from your cupboard straight away to equities is a bigger mistake, which people expect will not happen that easily. So debt and equity goes like brothers and sisters together. They go with the right balance. The higher the time frame, the more allocation to equities for me.
Also, will you put risk into perspective? I'm sure the risk dynamics of both assets like debt and equity are very different and very wide ranging in nature.
They are very wide range, because in debt we do not see, we rarely see a negative value. It requires a Six Sigma event like ILF is kind of an event, or a Vodafone kind of an event for debt funds to show negative NAV, whereas equity is so negative NAV the every other day. So that part of the preparedness, that equities can give negative return and hence needs a right balance. I strongly believe that the first decision to one should take when investing in equities is what is the tenure of the money. The longer the tenure, the more allocation to equities. The shorter the tenure, the lower the allocation to equities. Because in short term, equities can give negative returns or may not give the desired return. And the other factor which Bharat sir will I'm sure will touch upon is the goal aspect. What is the objective of the money? Why are we investing this money? What do we want to get out of this investment in terms of returns? Is it for our house? Is it for our future savings? A lot of these factors define where to put money besides risk and time frame.
So let's say as an investor, I've decided, I want to, like out of 100, at least 60, I want to put it into equities. I'm young, I have a normal income, I'm middle income age bracket, and everything fits into my spectrum. Where would you recommend, like how do you decide in equities, like where to put your money?
So we at Senora Sweta are someone who focuses on a fixed, predetermined universe, which is purely large cap. Because we believe that large cap provides you the safety in terms of the capital protection, where a Six Sigma event also will not erode your capital beyond the point. And a large cap equity gives you a liquidity as good as any debt fund. It is you can liquidate that investment at a blink of an eye. Within that, we believe that within the large caps, where do we see earnings and quality management is where we put our money. So in the longer term, it's the earning which defines the prices, and hence you should invest in sectors, stocks, management, which focuses and delivers earnings and minority wealth.
So Mridul, considering debt and equity both, so this question is to you also, Mr. Jaju. Should we use a top to bottom approach or a bottom to top approach? Like now we are considering, let's say, ever changing macro environment. So obviously we are discussing about top to bottom. Like how does this changing environment affects the debt and equity portion of a portfolio?
For me, top to bottom or bottom to top is a function of the time frame. The longer the time frame, it's easier to be bottom to top. the shorter the time frame, you will want to be top to bottom, whether in choosing asset class or within that asset class what to buy.
As far as I'm concerned, I think the market always has a theme. I just want to bring something to your notice. You said last year same time what was happening in US? The inflation was 2.5%, and the 10-year yields were rushing higher, right? So last year the market was pleading to the central banks that inflation is coming, please take action. Central banks are not taking action. Market decided on its own that we are taking the long-term yields to from 0.5% in US to 3% in US or 2% at that time. Today, you see what is happening. Central banks are pleading to the market that inflation is there. We are going to hike rates, but markets say, look, this will lead to recession. Therefore, I think there is no concept of top to bottom or bottom to top in my mind. You have to fit markets and the investors. If you put them together, they are like a jigsaw puzzle. So you have to put the blocks together and make a picture out of it, and then see which block fits where. And I think that's where Bharat sir's expertise come into place, because they look
Absolutely,
at profile.
yes.
Yeah.
I was just coming to that, sir. Mr. Pathak, sir, how would you fit this puzzle that Mr. Jaju was talking about? Like, how do you put the pieces together?
I think the biggest risk in equity is not the investment risk, but the investor risk. So if I put 100 rupees, the market goes down, I panic and I sell. So market went from 100 to 80, I sold at 80. Eventually it went to 140. मैं तो ट्रेन से उतर गया ना 80 में. So the investor temperament, investor concern is the biggest risk in equity. It is all very fine to talk about the long term and मेरा 10 साल का पैसा है, मगर 10 मिनट में अगर मेरा नींद उड़ जाएगा ना तो मैं कुछ कर नहीं सकूंगा. And that is where we have to look at how a tree grows. Tree grows its roots, and that is why we see the tree growing taller and taller. If the roots are not present, the tree will shake and it will fall. So this is the way we have to look at both debt and equity. That debt creates the foundation for me to have that peace of mind कि अगर 6 महीना मार्केट नीचे भी जाता है ना तो मेरा तो कुछ उसमें बिगाड़ने वाला नहीं है, क्योंकि मेरे डेट से मेरे को पैसा आ रहा है, my capital is safe. So it is not just for variety, but it is to make sure that my 6-month money emergency fund is in place, my 3-year, 4-year money is in place, I have to pay college fees for my child, and if at that time Taiwan and China and US start fighting, my college fees are not at risk. So that is where I want safe, liquid money which is available to me. And if my peace of mind has been created on that side, then I'm willing to step out of the crease and take equity risk. And then I'll be, so it's a quality of capital that I am temperamentally and fundamentally able to hold it for 10 years. That will allow me to compound. So I think this is the debt will form the foundation for me to erect the tower of equity.
So what are the top 3 or let's say 5 factors that you take into account when you do a risk profile from a customer end or a client, and when someone comes to you for asset allocation strategy?
Right. So obviously it is the personal situation which is material, and it is the market situation which is also equally important. So I'll say what is my current income, what is my age, what kind of runway do I have in future. And like Mahendra Bhai told very clearly, you will also find this in Peter Lynch's book, One Upon Wall Street, where he says your best investment is your own house. So it gives you a tax advantage. It helps you to save rent. It beats inflation over a period of time. And most importantly, on CNBC, every 15 minutes, a new expert will not come and say that, you know what, Vikhroli house prices are crashing, so sell your house before it goes down further. So I think that is an important point. So this is the way you start creating your long-term assets. So I 100% agree with Mahendra Bhai that yes, my own house, which allows me to beat inflation, beat taxes, beat rent, over a long period of time, something which I will not panic and sell. Have I put that in place? If I have taken a loan for that house, which I should, because I am buying an appreciating asset, I am not sure whether I'll take a loan for buying a car, but I am 100% sure that I'll take a loan for buying a house at the age of 25, at the age of 28, at the age of 30. But if I have taken a loan, I also need a term insurance in place, which will make sure that if something happens to the breadwinner, then the family is not left high and dry. They are not left without a roof on their head. This can be a declining term insurance, so you may decide to buy 10 policies. As your loan amount comes up, you start defaulting on each of them. Because भाई अगर घर में आके बैठे हैं तो छाते की कोई जरूरत नहीं आपको, तो step by step you can reduce the term insurance. So house mortgage term insurance is your first step. Your health insurance, accident insurance is your next step. And having created that, then you look at your long-term objectives, and you also try to understand your own risk temperament, because when someone else is doing it, it appears very easy. But when you have to do it yourself, when you go through that experience yourself, the chances of panic are likely to be there. You'll do self-destructive actions. So you have to guard yourself against that. So if you have a house in place, your insurance is in place, then you have your emergency fund in place, then I think the stage is set for you to look at your longer term objectives. So before coming to the longer term, you have to tick the boxes on the short term.
Correct. Mridul, I would like to bring in here. Do you agree with this entire thought process that we just heard from Mr. Pathak? Because I think in shorter term, equities does not fit into the picture anyhow for any capital or risk capital for that matter.
So the way I look at it is equities are your wealth creators. What Bharat sir pointed out was a very, very right point, that not many investors are ready to see the downturn. If the price falls from 100 to 80 and you sell off because somebody expert on a television or on a newspaper believes that the world is going into a recession and wants to exit, yes, then you are not mentally prepared for equity. The best answer to such scenarios are giving your money to somebody who understands equity to manage. And that is where mutual funds Sahi Hai or many other campaign from government or quasi-government has helped this wealth creation as far as India is concerned. The moment you give your money to expert, your panic button clicking goes down, because there's a process which is there to investment and there's a process there to withdraw. And hence you become a lot more disciplined in nature. And which is why while there's enough data to show that equities have given wonderful returns, not many people who have managed their equities by their own have able to beat that benchmark, because they always believe that, okay, we'll get a better opportunity to buy, so let's sell, or they will not buy at the panic because they will believe that more downturns are to come, which is where equity is a very, very planned long-term money and not anything in the short term, because in the short term, the volatility will make you take wrong decisions. What I slightly differ with Bharat sir, in spite of all his experiences, that while one should definitely invest in the house, it is about the balancing it with the equities. If you think that the economy is going to grow in a very, very robust manner, the the right ticks are there in the place, then not only will equities beat inflation, but they will help you to take a better home over a longer period of time. At 23, 25, you will want to take a 2 BHK at best. By the time you are 30, 35, you want to move to a 4 BHK. So that need is everlasting. And one of the best ways to meet that need for me is only equities in the long term by investing in right stocks. The biggest problem which I have seen in my 25, 30 years of experience is a lot of people believe that equity involved punts. And that's where the bigger error comes. In terms of Jajuji's language, he will touch upon that differentiating between debt and credit is like differentiating between quality equity and punt. And the language of Bharat sir, a wrong asset allocation is a bigger mistake. Similarly, investing in punts is like demeaning equities. Equities are not punts. They are investments for a long term. Only when you understand that, then only you should be in equities.
So the short-term volatility that we are currently witnessing in the markets, all the tensions around inflation, recession, the war, how, as an investor, should I be worried? Like, my equity portfolio is down, let's say, over 100% when COVID struck, and then suddenly recovered another almost 100% from the lowest levels, less than a year's time frame or something like that. So how do I play that entire period?
The best way to learn about this period is, as I said, please do not invest for the short-term inequities, which means that for all your short-term needs, as Bharat sir said, if I have to pay the college fees for my son or for my daughter or anybody, that money should not come from equities. Now, if you look at cycles, whether it is the Harshad Mehta scam, whether it is the Ketan Parekh scam, whether it's the Bear Stearns Lehman time, whether it is the LFS time, all these times the panic, whether if you have hold on to your equity portfolio during those panics, within 2 to 3 years, your portfolios have given much better return. Be it the Kargil time, be it any kind of a war other than the World War period. Even people who could survive for 5-10 years during the Great Depression or the dot-com bubble, they made a lot of money if you're invested in the right stock. So equities are not to be taken in the haste decision. That's the biggest education we give to our investors. Equities are planned. They are like insurance. आप 30 साल का इंश्योरेंस लेते हो, आप 20 साल का इंश्योरेंस लेते हो, आप होम लोन 20 साल का लेते हो. Equities should be invested like that. For anything which is lower than 5, 10, 15 years, please, it's a tactical bet then. For tactical bets, you need the right timing. For investments, you don't need the right timing, you need the right mentality, as Bharat sir said.
I'll come to Mr. Jaju. So what's your view from the debt perspective in this volatile scenario that we've seen in the last 3 years? Because in a rising inflation, interest rate scenario, we've seen bond yields are correcting and vice versa. So how should we play the entire debt investment spectrum here?
No, I mean, at the portfolio allocation level, I think we just need to play it the same way as equity. I mean, if you try to time the market, and I always say this, that if you can time the market, you should have timed the Nifty from 13,000 to 7,000 back to 17,000. You can't get that kind of return in the debt side, but that's more at the philosophical level. I think right now, as I mentioned earlier, last year the markets were pleading to central banks, inflation is coming, please act. And this time the markets are telling the central banks recession is coming, don't be so aggressive. So broadly, I think the long end of the curve is already pricing in rate hikes. Today, everyone on the street believes that the terminal repo rate for the current cycle for the Reserve Bank is going to be somewhere between 6 to 6.5%. And markets are not going to wait for the repo rate to go to 6% before they price that in. So at this point, I think at around 7.5%, the 10-year is pricing in a long-term spread of the repo to 10-year of between 100 to 150 basis points, and which is why I believe 7.5% is a very strong anchor for the market at this point. Obviously, things can change. New information comes with change of view, but I think at 7.5%, it's a very good level to invest. As far as the future rate hikes from the reserve banks are concerned, they will basically react more on the short-term rates because money market rates will move in line with the reserve bank's policy, but the long-term end of the curve doesn't wait for the policy action. It kind of pushes the central bank into policy action, so they move ahead. But in terms of investing in debt, I think there is a little subtle difference that we need to understand between equities and debt. In equities, all the hard work is done by the stock in which you invest. So let's say we are having this conference or webinar and you own a Maruti stock. So Maruti factory is running their manufacturing car, they are exporting and they're selling and they're earning profits as we talk. All I need to do is to remain invested in the Maruti stock. And once I've chosen the right, so it's like I'm the owner of the business. And that's where I just wanted to add one line, what Bharat sir and Mridul both said. When you are investing in equity, you have to mentally invest in the business, not in the equity. Otherwise, all this talk about having good temperament, etc., nothing will happen because you're mentally not investing in business. You know, when I start a business and it runs into a difficulty, I don't run away. I put double the hard work and double the capital. So I think the investing in equity is all about mentally investing in business and not in equity. But that's not my area. So coming back to debt, in debt, if you buy a 10% coupon bond for 5 years, after 5 years, whatever with the volatility in the market, it will end up giving you 10%. So in equity, you need to choose the right stock and let the company do all the right thing. In debt, you have to do it yourself because if you don't do anything, you'll get the fixed return. If you have to enhance your return, you have to get into active management of debt where you have to track the interest rate cycles, etc. And the first thing that we need to understand is just like the equity markets operate on 2 years forward earning, debt markets also operate on the expectation of the central bank and of the evolution of the macroeconomic fundamentals 1 year ahead, which is why you see when Fed is hiking rate, the long-term rates are actually going down. So I just can't emphasize this point enough. That requires a very, very rigorous, hard work and lots of experience and understanding, which is why I said market has a theme at all times. There are times when market is willing to put all the negative news under the carpet, and there are times when the market is not reacting to the most surprising of the positive news. The trick to investing is to understand that, which is why people say investing is 10% intelligence, 90% temperament, and I think in different ways, Mridul and Bharat sir are saying the same thing. Once you have done the hard work, once you have chosen the right investment option, how to remain committed to that is the trick. And therefore, I think, again, investing in markets is like an Everest expedition. So you see, every year, lakhs of people try to mount Everest. In 3-4 years' time, 2 or 3 people succeed, right? So if you look at the journey of the stock markets, there are 5 or 10 or 20 stocks which have given all the return. If you take the thousands of casualties, you look at the movie industry, right? There are 3 Khans and 2 Kumars who are the ones who are ruling the roost for last 20 years. They've made all the money. You look at the cricket, there is one Tendulkar, one Dhoni, one Virat Kohli who has made all the money. Others are just basically running their household. I mean, now with the IPL, they are able to make a little more money. Now with the TV, some big great stars are also having a decent life. So investing is all about choosing the right stock, not the stock, but the business. Debt is also choosing the right strategy, understanding the macro fundamentals very well. And that is where the active management of debt comes into play. But you can cut all this and say, look, debt interest rates will go up and down. Can I become an LIC? Rates go up, I buy. Rates go down, I buy. Because I continue to get LIC a new premium money every year. If I'm an investor, if I'm a salaried person, I get money every year. Why do I have to even worry about where interest rates are going? I just invest like I do SIP in equity, I do SIP in debt. So if I can become LIC by simply following their strategy that buy whatever with the interest rate. At the end of the day, LIC, if you remember, is the only institution in the country which gives you guaranteed return, apart from the bank fixed deposits. So if LIC can do this, we can do this. So there are two parallel approaches that you can take. Either you can go for active management to maximize return, or you go for a stable, irrespective of the interest rate environment, to achieve your objective at the end of your target period. So this is how the debt markets work.
Absolutely. I do understand active management is where all financial advisors come into the picture. So, Mr. Pathak, how actively you were able to, digress the all your clients set over the last 3 years, like pre-COVID, COVID, and now post-COVID?
So I'll first speak about the debt side, and I think we have to follow a very, very boring approach to debt. The reason is that tax efficiency comes if you hold it for 3 years. So then I have no illusion that I can predict interest rates, I can predict inflation, I can predict crude oil prices for the next 3 years. And here, like we said in equity side, in debt, we have to come to a hold to maturity, HTM mentality, because it is 3.5, 4 years holding that we want to do. And like Mahendra Bhai said, every year new cash flows are coming. So anyway, if I say that every February I take a 3.5 year investment in debt, I don't think I'll make a very big mistake. Active management in debt is not the cup of tea for individual investors for sure, because this is a very different market. There are very large players like banks, primary dealers in this market. And even after doing all the smart work that an individual may be able to do, whatever he makes, he will lose by way of tax. So I think very clearly, if I'm able to get the hold to maturity mentality, I keep the management expenses as low as possible, and I push the credit quality as high as possible. Then I have filled the compartment of my debt side, and then whatever activity I want to do, whatever risk I want to take, I should focus on the equity side. So debt should become my sleep well at night portfolio, hold to maturity mentality, sovereign, semi-sovereign, quasi-sovereign type of investments held with a 3.5, 4 year perspective. So boring but profitable approach.
And equities is interesting and profitable, highly profitable.
So this is like I look at it from a product mix perspective. So if you are running a factory, you know that there is a large customer who gives you volume, doesn't give you good costing, he squeezes you on the margin, but he pays you on time. So you will say that when I'm running my factory, my wages, my electricity bill, my MIDC payment, etc., will come from this kind of a प्रोडक्ट. तो बजाज ऑटो का धंधा करता हूं तो ज्यादा मार्जिन नहीं देगा मगर टाइम पे पैसा देगा. Then I say for other type of customers, they may not pay me in time. 60 दिन बोलेंगे, 90 दिन भी पैसा नहीं देंगे, मगर 15% भी मार्जिन चार्ज करूंगा तो दे देंगे, क्योंकि उनको भी दूसरा वेंडर मिलने वाला नहीं है. So I think the debt and equity, I'm taking another example, that एक बाजू आप फिक्स कर लो कि आपका पैसा जब चाहिए आपको मिलेगा, आपको टाइम पे मिलेगा, ज्यादा मार्जिन नहीं मिलेगा. दूसरी साइड में प्रोडक्ट मिक्स कर लो आप कि अतुल ऑटो का ऑर्डर भी आता है तो ले लो, उसमें 20% आपको शायद मार्जिन मिल जाएगा. सो दिस इज अ प्रोडक्ट मिक्स इशू, एंड द वे यू मैनेज योर बिजनेस, यू हैव टू मैनेज योर पोर्टफोलियो इन दिस एलोकेशन. And I don't think only one of the two is good. It will always have to be a combination. So अगर ब्रेकफास्ट में सिर्फ जलेबी खाएंगे तो नहीं चलेगा, सिर्फ फाफड़ा खाएंगे तो नहीं चलेगा. जलेबी फाफड़ा दोनों चाहिए आपको. But you have
Absolutely.
to, but you have to watch the quantity.
Absolutely.
I have one query, Bharat sir
Yeah.
and Mahendra sir, because you just touched upon the fact that credit quality should be the best. It reminds me during my institution days, there was a product which became very favorable in the market, which was FCCB, fully convertible preferences, where a lot of hedge funds and investors got a flavor of debt plus equity, where the returns were of equity and they thought their money is safe like a debt. And when that bubble busted, it impacted the global markets, including India. Similarly, pre-ILFS, there was a lot of credit which happened. Now, equity suffers when such kind of products become the flavor. How do you handle the investor queries when they think that there's something called free lunch? We all know, we have read that there's nothing called free lunch, but there are certain illusions which create such environment. How do you handle that period is where I want to understand, because I think that is the best time for a learning for an investor, and that's the toughest time to protect your wealth.
Bharat sir.
So, and I'm sure different waves, different themes, different fads keep coming in the market. And you cannot really stop investors from participating in those. If you are able to draw a line for them, एक लक्ष्मण रेखा अगर आप उनको ये बना सकते हैं कि आपको जो इच्छा है करो, मगर इसके अंदर रहो. So I'll give you a story of one of my friend's father who in the 70s he used to work for Hindustan Lever, and he said कि हर महीने में जब सैलरी आती है तो 50 रुपए का मैं लॉटरी टिकट खरीदता हूँ. And he said, I understand that statistically the chances of winning a lottery are very, very minimal. But he also said that statistically, chances of winning in a lottery are zero if you don't buy a ticket. So my chances are better than that. But I have this great discipline कि मैं खरीदूंगा तो 50 रुपए का ही खरीदूंगा, हर महीने खरीदूंगा. वो बोलते थे उन दिनों में टीवी नहीं रहता था, मूवी देखना भी बहुत महंगा रहता था, तो सपने तो देख सकते थे ना महीना भर कि लॉटरी मिलेगा तो मैं क्या क्या कर सकता हूँ. Then there was this excitement. So see, you cannot take excitement away from people's life. You cannot put them in rational buckets and try to make it. But what percentage? So उनका सैलरी अगर 5,000 रुपए था और 50 रुपए का खर्चा करते थे ना लॉटरी पे, वो ठीक है. अगर उल्टा हो जाता है तो प्रॉब्लम है. So there will be some things which people want to attempt, and you should let them learn from their own experience, because very few of us can learn from someone else's experience. But the key is the allocation to that. So I mean, if we say 50-50 debt to equity allocation, we should look at 45 to debt, 45 to equity, and 10% for innovation. If you put that in place, I think you can burn your fingers, but you won't burn the house down.
Absolutely well said. With that, let's wait. We'll open the floor for Q&A. We'll wait just for 2 minutes for all the Q&A to assemble. Just an announcement for all the attendees. Whoever wants to post the questions, you can do so in your Q&A tab on your screen. Okay. So the first question that we have is for Mr. Jaju. What are your views on REITs and investors? Many retail investors these days seem to consider them. Sorry, this just moved up. Consider them as a good alternative to traditional debt investment options such as debt funds or fixed deposits. Do you think they are worth including in debt allocation portfolio of a balanced portfolio?
I think REITs and InvITs are an emerging asset class. They are already very well established in the developed markets. I think this is a extension of how the retail investor is able to today participate in equity without the traditional risk of investing in equity where he gets trapped with the operators and all that. Real estate also has a space in the portfolio allocation. Now let's say someone has a very small portfolio, let's say someone with a portfolio of 10 lakhs, he can't buy real estate realistically, so he can invest in a REIT and therefore own a part of the underlying real estate owned by the real estate. Even I, as a fund manager, I can't think of buying a commercial asset. So if I want to buy a 5-star hotel, I have no way I don't have that kind of money. But if there's a 5-star hotel REIT, I can invest in that and participate in the growth prospects of that business. So REITs are again of two types. One which give a fixed return, which is like a debt instrument. Then there are hybrid REITs which give a combination of the fixed return and the participation in the growth prospect. So the investor has to choose very carefully. I think Bharat sir just mentioned in the previous question and about the CCCFs, and I would generally say there is an asset class called alternative investments. It's classically called alternative investment. So there should be a component of the portfolio which should go into alternate investments. REITs and InvITs will fall part into that. I don't think it should be in replacement of debt or equity. It should be in addition to debt and equity. Therefore, the correct way to approach this is to have a allocation to alternate investments in the portfolio, as Bharat sir said, and within that it should fit. How much to alternate investment is a function of the risk appetite of the respective investor. Shweta, you are on mute. Can you?
Another question is, when do you feel the interest rate will stabilize?
I wish I knew that. I think we are facing today the kind of uncertainty which we have not faced in a long time. We have just come out of COVID, and then we have come out of, we are still going through the one geopolitical disturbance between Russia and Ukraine, and we are already looking at another one. The biggest risk right now, to my mind, is that the central banks are significantly behind the curve. And I think I touched upon this in different sections of the webinar, that market had seen inflation coming much ahead of the central banks. To that extent, I think long rates are already at optimum level. So the biggest risk to the debt markets come now from US, where the Fed has got itself into a very ugly situation, I would say, not even difficult. If they raise rates, recession will come. If they don't raise rates, the recession will come. And that can have implication on India. There are geopolitical events, but we have to just give you one example, that the kind of the FPI selling that we have seen in the last 6 months, any other time, I think equity markets in India would have collapsed, the currency would have collapsed, the fiscal math or the macro of the country would have collapsed. But what we see today is a very strong India, where India is expected to be the fastest growing country in the world. Our currency is one of the best performers. So I think the way we deal with the crisis has changed, and that's where I think we have to give credit to the administration. And I'm not talking of the government necessarily. Look at the RBI, how swiftly it has changed from being ultra accommodative to ultra hawkish. So there is a lot of pragmatism in how we deal with the new problems now. And to that extent, I believe that there will be a lot of challenges in the rest of the world, but India will be affected, but relatively better handled. and therefore I think long-term rates are already pricing in the worst case scenario. There could be panic episodes like suppose there is a sudden flare up in the geopolitical activity or Fed goes ballistic. There is every chance of Fed having to go ballistic. I don't think they will have a choice. So today we are expecting Fed to go to 3.5%. They may end up 5%. And that could lead to sudden spike in the yields, but I think those will be the buying opportunities. But if I'm looking at a core portfolio, and I just want to add one product, there's a new category of debt mutual funds called target maturity fund.
Absolutely.
That is one which every debt investor should look at very carefully. It is as close a substitute to a bank fixed deposit with significantly better advantages that we had ever. So if, because the environment is so uncertain, but the market is already pricing in a fair bit of hawkishness and rate hikes by the central banks, that product I think is the best product to invest in the current scenario. In my view, you don't get affected if the rates continue to go up, but because the long-term rates are already at the long-term average, you get a significant yield pickup. So let's say today a 5-year target maturity fund will give you something between 7.25% to 7.5% of a return, which is virtually tax-free because of the indexation benefit. I think that's a very good product for a retail investor. Like Bharat sir said, the debt markets are not for retail investors. They're very complicated and completely dominated by institutional players. So target maturity fund, I would say, is a very appropriate product to deal with this uncertainty.
Okay.
Actually, I couldn't agree more with Mahendra Bhai. Target maturity funds are like open-ended FMPs. So there is very clear visibility on what kind of maturity amount you'll get, and that is where that hold to maturity concept also can be ingrained in the minds of the clients. Mr. Manoj Munot has asked a question. Actually, he has asked two questions. One is to Mahendra sir, that when the rates will stabilize. Rates never stabilize. Market is always dynamic, and it will keep moving on both sides. So it's like the ECG. ECG जिस दिन straight line हो जाता है ना, तो फायदा नहीं उसके अंदर. But I mean, jokes apart. He has asked how you manage to control the emotions of the clients in rising market with allocation in debt. So I'll take the example of a target maturity fund, and there what I can do is draw a chart of the invested amount and the maturity amount, because both the visibility is there. So this will look like the asking run rate in a cricket match. And it is possible that you lose a couple of wickets, your rate will slow down. It will look below the required run rate. But at the same time, you know that the YTM has gone up and the future run rate has increased. So finally, you will end 1 run more than the target. So if you can draw this chart of required run rate and actual run rate, and how the target, I think that helps clients to control their emotions as far as the allocation in things like target maturity funds are concerned. I hope that answers the question.
Yes. So there's another question with respect to duration.
So Sweta, if I can just add to what
sure, please.
Bharat sir was saying, see, there's something called valuations that we talk about in equity market. So let's say if the market is trading at a PE of 12, you don't really get afraid of losing big time. You may have some volatility for some time, but at 12 PE, you would be very happy to commit. So today, like I said, the center, everyone knows that the RBI and the Fed is going to hike rates in future, and market is already pricing in that. So the question therefore is how much more than what is the current expectation that the central banks will go. So when the market knows that the rates are coming, they are priced in. When everything is negative in terms of macro, the good part of that is the market has priced that in. Now, if the interest rates are expected to rise further, I just come back to the same product, target maturity product, because what investor wants to know is that what happens if the rates go up, how much he can get hurt or how much negative he can get. And as we explained that in target maturity fund, if the interest rates continue to go up, you are likely to get your base return of 7.25 to 7.5%. On the other hand, if the interest rates come down in 2 years' time, you may actually have capital gain. So what is important is to get the fear of damage out of the investor's mind, which you can provide through the target maturity fund.
Absolutely. So next question is again on duration, from the duration perspective that Mr. Pathak was talking about. Can we add PPF as a debt portion considering the credit quality and everything, but it's again, the duration comes into the picture.
So there is a limit of 1.5 lakhs a year. You get tax deduction for that. So if you are looking at, if you are in the 30% tax slab with 10% surcharge, etc., 34% is the tax that you save. So when you invest 1,50,000, your net investment is only 1 lakh, and it is going to mature at 1.5 lakhs. So everybody can create this pre-tax, post-tax spreadsheet on PPF, and I really feel bad that the limit is only 1.5 lakhs. If the limit was 5 lakhs, I would have invested 5 lakhs in PPF and got more tax benefit. I think this 1.5 lakhs, forget about whether it is debt, whether it is sovereign debt, etc. In most of the times, equity will find it difficult to beat PPF on a post-tax basis. So I think that the question doesn't even arise in my mind whether I should allocate that 1.5 lakhs to PPF every year.
So
In each family member's name, if I can do it. Nowadays, HUFs cannot do it, so unfortunately, that one avenue is not there. But each family member should take advantage of this.
So does same holds true for NPS?
But NPS is a mix of debt and equity. Here, there is very, very clear visibility on PPF. So in NPS, obviously, equity markets over a longer period will do better than PPF. And if you get the tax advantage, yes, NPS also can be considered.
Okay. Okay. One question we have for you, Mridul. Are you suggesting large cap funds can be substitute as debt and liquid assets?
So I will not call a fund. I believe a quality large cap, a company which can grow its business. As Jajuji said, you need to invest in the business, can substitute to a debt fund if invested slowly and steadily. Again, the money has to be very long term in nature, where you don't see a need for that money in the short term. For me, investing in the basket of stock is important, but what is more important is to invest in the business with the right earnings rather than anything else. That is the way I look at it. I have one interesting observation, and I want to just ask a view of both my co-panelists there. Mahendra sir, you rightly said that most of the central banks are feared to be behind the curve. Don't you think they have been more, I will say, controlled by the governments because of COVID environment? And we have seen in the past, whether it's the South Asian currency which happened, or the Latin America crisis which happened, that whenever central banks are governed by the governments, it leads to crisis, which is where my fear is that US might be heading into a big crisis. And knowing what is happening on the geopolitical side with China, my thesis around India is super bullish of not only the fact that the way we manage this COVID scenario, we're not printing demand driven, inflation driven money, but managing this crude like a scenario, this FBI selling scenario. That's the whole thesis of me being super bullish on Indian equities, is that there are so much risk to other global major players, which India doesn't portray as of now. and which is why I believe that we'll see unprecedented return in Indian equities in the medium to long term. Somewhere from a macro perspective, do you agree that India is in the best place? I know you will not comment on the equity return part. I leave that for myself to comment. But from a macro perspective, because of the history of central bank being governed by governments lead to crisis, what's your take on that side? And obviously, Bharat sir, your view there.
I think India is definitely is in a very strong situation, and largely because of the way the situation has been managed. So you just think about some of the fortuitous events that have happened. So India could discover vaccine in good time, and so there are two parts to the COVID management. One is that India was lucky to get the vaccine at the right time. Now you can say whether India has that kind of research capability, whether it is the Oxford vaccine. The second part is the administration of the vaccine. So there are the combination of the uh, ability to discover and then to implement. On both counts, India stood very well. But I think we should not take an extreme view of the situation because that to chand mein bhi hota hai. So I don't think India is a very, I mean, India is just on a relative basis in a good position. India happened to have very strong reserves at the beginning of the global crisis. So central banks are obviously guided also to some extent by the political considerations. But when we are in the markets, we don't worry about why something is happening. The fact that it is happening and what impact it can have on us is important. Now, we cannot get into the ideological debate of whether central banks should have done this, that, or the fact is that this. Now, I agree with you completely that US is headed for a catastrophe, right? As I said, they have put themselves in such an ugly situation that heads they lose, tails they lose. I don't think US can come out a winner in this situation. Now, what is the biggest risk to India? Everything being, 100% good for India. India is a current account deficit country. Every year we need huge foreign capital flows to balance our, current capital account. Right now we are facing perhaps the highest ever current account deficit that we ever seen. In 2013, our current account deficit was almost about to hit 5%, and that was a very bad time to have the taper tantrum. Today we are talking of 4% current account deficit possibly this year, and it was estimated at just about 1% in January, 2% in March, 3% in June. So you see how quickly the situation is deteriorating. We are looking at a 40 billion current account, trade deficit every year, every month now. We are looking at financing something like $200 billion of current account deficit, which is almost equal to 40% of our reserves now. So we are extremely vulnerable to a choke of the liquidity at the global scale. And we are talking of a time when the Fed is beginning to step up its liquidity withdrawal from the system. I think there is still a lot of macro risk, and we should not be under the illusion that India has suddenly become the best market to invest or best country to invest. And so far we have this SIP which is keeping the flows intact and all that, but I think we are in a very strong position. I am very bullish on India. I am also very optimistic on the equities market, but we can get shocks in between, which we have to be prepared to handle. And the other part is that we are trading a very fine line in terms of the macro balancing. So just to play the devil's advocate, I'm not, this government, BJP government, is a very proud government. They magnify every achievement and they downplay every failure. Okay. In spite of that attitude, for the first time, the finance minister said that we are facing twin deficits of current account deficit and fiscal deficit. RBI governor repeatedly talked about the current account deficit yesterday. So we are treading a very fine line, one misstep. So if that misstep does not happen, I am on your camp. If that happens, then it could be any side.
Sir, a continuing question to Mr. Pathak. Sir, in either scenarios, how should the asset allocations change for a client, or should it at all change in the current scenario?
So I think all future forecast projections have to be looked at on a probabilistic basis. So there is never 100-0 on anything. Is it 60-40 in favor of India? It is 65-35 in favor of India. I think the answer is yes. We have done a lot of right things, and the way we have managed the fiscal deficit, the way we have managed even the corporate tax, the GST has helped, PLI scheme has helped, FDI is coming in a big way. So we have done some right things. The global situation, however, there are too many moving parts in the global situation, and we cannot be complacent on those sides. So we say if my normal allocation is 60-40, can I go 65-35? Can I go 70-30? But I cannot go 100-0, and I cannot go 200 long with 100 borrowing. I think that will be a recipe for disaster, because a lot of things can actually go wrong. So the tilt should be in favor of India equity, but it cannot be a 100-0 situation.
Absolutely. I think, yeah, on the questions we have done through, so let's close the session.
Yeah.
Thank you all for your insightful session today. We've understood that asset allocation triumphs all other investment choices that an investor has. The first comes house, insurance, debt plays an anchor. Equities is where your long-term wealth creation happens ideally. So it's a mix, it's a diversified portfolio that one looks at. And obviously, in the current scenario, we are in fact overweighing on India across the board. We understand that current account deficit, fiscal deficit is where the government is treading right now, and US recession can have repercussions on India. But as Mr. Pathak rightly pointed out, it's the probability that we consider in, and how much is already priced into the markets, both equities and debt. So considering all these factors, yes, asset allocation is very important. Debt plays its own role of an anchor, where equity plays its own role of creating exponential growth over a longer period of time. So considering your age, your risk capital, your appetite, the goal orientation into the picture is what the different parameters are we should look at in understanding where to invest in. With that note, I would like to end the session. Thank you all for attending it and sharing your knowledge with us. Have a nice weekend, guys.
Thank
Bye.
you, Sita, for being a very good lecturer, and thank you for inviting us today. Thank you.
Thank you, audience. Thank you, co-panelists. Thank you, Sweta.